Hello viewers, so welcome to my channel. I'm Hasham Ali Khan. In this video, I'm going to start a new accounting standard AS11. Last video, I have completed the accounting standard AS10. That is property, plant and equipment, PPE. And after that, we have solved a number of problems on accounting standards. So many videos I have uploaded on problems on accounting standard. Now in this video, I'm going to start AS11. That is accounting for effects of changes in the foreign exchange rates. So this is the title of this accounting standard 11. So before starting the discussion on this accounting standard, take the screenshot of the points which I have written on the board. In this video, I'm going to explain about the introduction of AS11, the scope of AS11, then different definitions which are used in this accounting standard. Then last one, foreign currency transactions. All these things I'm going to explain, so watch the video till the end. Take the screenshot, then I'll explain. Now, see, the title of this accounting standard is Accounting for Effects of Changes in the Foreign Exchange Rates. Now, after globalization, that means many countries are dealing not only within the same home country, but also with other countries, other different countries. That means due to globalization, the world economies are integrated. The activities of an enterprise is not confined only to their home country. The activities are spread throughout the world. That means there is a need of converting the currency from one currency to another currency. So in this accounting standard, we are going to explain you the accounting treatment of foreign transactions. So what is the introduction? The standard deals, this AS11 deals with the issues involving accounting for foreign currency transactions. There are many transactions which are taking place between different countries. That means different currencies are involved. So all the issues regarding the accounting for foreign currency transactions and foreign operations, and that is to decide which exchange rate to use, because the exchange rate is not same always. Time to time the exchange rate, foreign exchange rate will change. So which exchange rate we have to use when the transaction takes place, and how to recognize the financial effects of changes in exchange rates. See, exchange rate changes time to time. So what is the effect, what is the impact of these changes in foreign exchange rate on financial statements? So these topics we are going to deal in this accounting standard. Now, scope. What is the scope of this accounting standard? What are the areas which are covered by this accounting standard? First of all, this standard should be applied in accounting for transaction in foreign currencies. If a business does not have any foreign transactions, for that business AS11 is not applicable. So AS11 is only applicable to those business organizations which have foreign currency transactions. That means the business is dealing with foreign countries, with companies in other countries. So whenever foreign currency transactions are there, for them only this AS11 will be applied. In translating the foreign financial statement of foreign operations, suppose the home country is India. That means the company is located in India, but it is having foreign operations. It is having branches in other countries. So there is a need to translate the financial statements of other entities into the reporting entity, right? So translating the financial statements are also covered by this AS11. Next, this statement also deals with accounting for foreign currency transactions in the nature of forward exchange contracts. What are forward exchange contracts? I'll explain in the definitions. So whenever a party is engaged in foreign exchange contracts, forward exchange contracts, for them also this AS11 is applicable. So this is the scope where this standard will be applicable. Now, however, the standard does not cover. So what are the areas on which this AS11 will not cover, is not applicable? So first area is restatement of financial statement in different currencies for convenience of users. Sometimes a company will convert the financial statement into different currencies for the users, for the purpose of users, then accustomed to reporting in different currencies. That means a company is accustomed in converting the financial statement of different countries into their home currency. For them, this AS11 is not applicable. Cash flows from foreign currency transactions or operations. So making cash flow statement. Again, for making cash flow statements, this AS11 is not applicable. Thirdly, exchange rate differences of foreign currency borrowings. Exchange rate differences on foreign currency borrowings to the extent they are regarded as adjustment of interest cost. When a company borrows from other countries, they have to pay interest charges. That means the differences in exchange rates will be considered in interest cost. So for them also AS11 is not applicable. So what I have discussed so far regarding the introduction, that means why this accounting standard is applied in order to solve the issues for foreign currency transactions, which exchange rate to be used, and then what is the effect of changes in the exchange rates on the financial statements. That is the introduction. Then what are the areas in which accounting standard is applicable, and what are the areas on which accounting standard is not applicable. Now definitions. A number of definitions are used. That means terms are used in this accounting standard, for which you must know the meaning or definition. So now I am going to explain you the meaning of different terms which are used. The first is average rate. It is the average of exchange rates in force during a specific period. Just now I told you the same exchange rate will not be there always. The exchange rate will fluctuate every day. So we need to take the average rate. So simply average rate is the average exchange rate over a specific period of time. For example, what is the average rate in 1 week? What is the average rate in 1 month? Like that. Next, closing rate. It is the exchange rate at the balance sheet date. When we close the accounts, when we prepare the financial statements, on that date, what is the exchange rate? That is the closing exchange rate. Then exchange rate, very frequently in examination they will ask you the meaning of the term exchange rate. The rate at which one currency is exchanged for another currency. For example, presently the dollar rate is rupees 81 per dollar. Presently rupees 81 is equal to $1. So 87 units of Indian currency is equal to 1 unit of foreign currency. That is called exchange rate. So we need the exchange rate to record the transactions in the reporting entity. So it is the rate at which two currencies can be exchanged. It is the price of one currency in terms of another currency. For example, the price of $1. The price of $1 is 87 rupees. That is the exchange rate. Next is exchange rate difference. Time to time the exchange rate will change. So what is the impact on the financial statement due to the change in the exchange rate? That is called exchange rate difference. So here it is a difference resulting from reporting the same number of units of foreign currency in the reporting currency at different exchange rates. For example, $100. $100 is equal to 8,100 rupees at present. Suppose the exchange rate increased to 82 rupees per dollar. Then 8,200 rupees for $100. So this is the exchange rate difference. Earlier it was 8,100, now it is 8,200. So this is called the difference in the exchange rates. For the same amount of foreign currency, how much is the amount of the reporting entity? Fair value. It is the amount for which an asset could be exchanged or a liability settled between two knowledgeable, willing parties in an arm's length transaction. So beforehand the transaction which is exactly in front, that is called arm's length transaction. So in an arm's length transaction, it is the amount for which the asset will be exchanged or a liability will be settled between two knowledgeable person willing to enter into contract. So when two parties are there who are willing to enter into contract on arm's length transaction, and the amount at which the asset will be exchanged or the liability will be settled, that is called fair value. Next is reporting currency. It is a currency in which the financial statements are reported by an entity. For example, in India, the home currency is rupees. So reporting entity, that means reporting currency is rupees, because all Indian companies will make the financial statement in terms of rupees. So that is called reporting currency. Indian rupees is the reporting currency for India. Then foreign currency. It is the currency other than the reporting currency. For example, in India, the reporting currency is Indian rupees, whereas foreign currency is euro, dollar, pound, yen, etc. So any currency other than the reporting currency is called the foreign currency. Next, foreign operations. Foreign operation means foreign activities. So an entity will conduct foreign operations due to associates, due to subsidiaries, due to branches. A company located in one country will make subsidiary in another country, will make a branch in another country, or make an associate in another country. Then foreign operations will arise. So it is a subsidiary or associate or branch of the reporting enterprise, the activities of which are based or conducted in a country other than the country of the reporting enterprise. The activities are conducted in any other country other than the reporting country. Right. Next one is integral foreign operation. Integral foreign operations. It is a foreign operation, the activities of which are an integral part of operations of the reporting enterprise. Suppose the reporting enterprise is an Indian company. So all the major operations which Indian company is conducting with abroad, they are called integral operations, integral foreign operations. The non-integral foreign operations, it's a foreign operation that is not an integral. The integral are the main activities of the enterprise. Then apart from that main activities, the other activities are called non-integral activities. Monetary items, the items which can be measured in terms of money. So all the assets and liabilities, these are the assets and liabilities to be received or paid in fixed or determinate amount of currency. When any asset or a liability is expressed in terms of fixed determinate amount of currency, that is called monetary. Then non-monetary, these are the assets and liability other than monetary, other than money terms. That asset and liability is called non-monetary item. Forward exchange contract. There are two contracts, spot contract and forward contract. Spot contract is a contract where buyer and seller will buy and sell on spot. At the same time, buyer will complete its obligation, seller will complete its obligation. It is called spot contract. The other type of contract is forward contract. In a forward contract, the agreement is made now, but the transaction will be settled on a future date. That is called forward contract. So here forward exchange contract, it is an agreement to exchange different currencies at different foreign exchange rates. That means two parties enter into a contract for future transaction. For example, A and B enter into contract. A wants, suppose $1,000. So A wants to buy $1,000 and B wants to sell $1,000 after 1 month. So presently A and B are entering into a contract that after 1 month A will buy $100 and B will sell $100 at a certain fixed rate. That is called forward exchange contract. Forward rate. It is the rate at which the forward contract is settled. Just now I have given the example A and B. A and B enter into a contract that A will purchase $100 and B will sell $100 at a fixed rate of 80 rupees per dollar. This rate of 80 rupees which is agreed between A and B is called forward rate. Next, foreign currency transactions. A transaction in which foreign currency is involved. This foreign currency transaction mainly will occur when a company, when a reporting entity is conducting the transaction with a foreign entity. So, a foreign currency transaction is one which is denominated in or requires settlement in foreign currency. So, denominated in a foreign currency or settlement in a foreign currency, that is called foreign currency transaction. Example, in case of imports and exports, the importer will enter into a contract with the exporter for certain price. But the importer in India, exporter is in US. The importer says we want to purchase a machine from US. The US person says we will supply at $1,000. $1,000. That means the Indian company has to pay $1,000 to the American supplier. Then American supplier will sell the machine. That means they have to exchange the transactions, exchange the currency. The Indian entity has to purchase foreign currency and pay it to the foreigner, pay it to the supplier. So they include transactions wherein an enterprise buy or sells goods or services priced in foreign currency. This foreign currency transaction will arise whenever we buy the goods or supply the services, which has to be conducted in a foreign currency. That means we have purchased some goods from US. We have to make the payment in US dollar. Similarly, we will sell the goods to another country. We'll get the foreign currency and we have to convert that foreign currency into home currency. So, second one, borrows or lends funds and amount is denominated in foreign currency. Nowadays, capital is freely flowing from one country to another country. There is exchange of funds between different countries. The borrowers and lenders are staying at different places. Borrowers and lenders are staying at different places. In that case also, there is a need to convert the currency. That is also a foreign currency transaction. Next one, because a party to an unperformed forward exchange contract. A party to an unperformed foreign exchange contract. A foreign exchange contract is a contract in which the agreement is made now but the settlement will be conducted on a future date. That is called foreign exchange contract. So if foreign exchange contract is unperformed, then the party to the foreign exchange contract also again said to be under foreign currency transaction. Acquires or dispose of assets or liabilities denominated in foreign currency. Acquires the asset or settlement of liability in foreign currency. That is also a foreign currency transaction. So these four items will come under foreign currency transaction. Now, accounting standard. This accounting standard AS11 prescribes the accounting treatment with respect to initial recognition. This accounting standard is concerned with initial recognition, then valuation at balance sheet and contingent liabilities and treatment of exchange differences. So all these will come within the ambit of this AS11. What are the things? First of all, initial recognition. I'll explain you what is initial recognition now. Secondly, then valuation of balance sheet debt. We have to find out what are the expenses, incomes, assets, liabilities on the balance sheet debt. Thirdly, contingent liabilities, the liabilities which are dependent on some condition. Lastly, the treatment of exchange differences. That means the exchange rate will not remain constant, it will change from time to time. So what is the effect of these changes in exchange rate? All these things are covered by this AS11. The first point is regarding initial recognition. So what is initial recognition? When a transaction happens, it is recorded by applying the exchange rate. Transaction, for example, Indian exporter is exporting the goods to a foreign entity. In that case, as soon as the transaction happens, it has to be recorded. So we need to record in the reporting entity's currency. The reporting entity is Indian company. So we have to convert it into from dollars into rupees. So it is recorded by applying the exchange rate between reporting and foreign currency at the time when the transaction happened. So at the time when transaction happened, we have to find out what is the exchange rate. So by applying that exchange rate, we have to convert one currency into another currency and record it at initial recognition. For practical purposes, average rate for a week or a month can be used. So normally, for a practical purpose, if there are no fluctuations, if there are no wide fluctuations in the exchange rate, then simply we take the average of weekly or average of monthly to convert the transaction from one currency to another currency. That's it. So in this video, I have explained you about the introduction of AS11, that is accounting for effects of changes in the foreign exchange rates. Introduction, scope, then definitions I have explained, then what are foreign currency transaction I have explained, and the initial recognition I have explained. So this is the first part of this AS11. Inshallah, in the second part, again I'll continue the discussion on this AS11.